Good morning. Welcome to Trading Hour. It's a Wednesday morning at 11 o'clock. Things are looking up much better. We had a gap up opening. We've managed to build on it. The Nifty right now is up 150 points above 23,100 and very close to yesterday's intraday high of 23,137. So the street's going to watch whether we can conquer that. But the real pullback and recovery is seen in the broader markets. The mid-cap index is up nearly 2%. Small-cap index, a very smart pullback after the thrashing that they got earlier this week. The advanced decline ratio looking up at close to about 7 stocks advancing for 1 in the red. Banks are catching up, so the Nifty banking index is also up nearly about 0.5%, but the heavy lifting leadership is coming in from the IT names.
Absolutely right. Good morning, Rima. Much better looking screen compared to what we've been used to in the past couple of trading sessions. Like you mentioned, it's a very sharp rebound as far as the broader end of the markets are concerned. A couple of stocks on the radar. The entire energy pack today is seeing a bit of a rebound. So energy stocks, especially Suzlon, very strong set of numbers, very strong execution. That stock is doing very well. On the other hand, JSW Energy, on the back of a weak merchant spread, actually has seen further fall. In fact, if you pull up JSW Energy, especially over the last 2 weeks or last 15 days, you'll see that that particular stock has seen quite a bit of selling pressure emerge, and it'll be interesting to see whether that particular stock can actually rebound, almost 25% down in the last 1 month. The other set of stocks that actually have seen significant selling pressure emerge in the last few trading sessions was the pharma pack. But today, some of the important pharma names, some of the biggies have rebounded, especially after a good set of numbers coming in from Cipla. Have a look at Sun Pharma, that's doing very well. Loris Lab, that was beaten down day first day. Today, that too has seen some buying emerge. But overall, a green looking screen, and recovery is the name as far as some of the beaten down sectors are concerned.
Indeed, so CDSL has rebounded. Netwear, which got hit, it was down 10% yesterday, off more than 50% from its 52-week high. The management, is sending out a release to the exchanges saying that the developments coming out of China, the Chinese AI startup DeepSeek, only expands the market opportunity, so not so much of a threat. The stock has rebounded, and even EMS companies. On Keynes Tech today, there was an upgrade by Jefferies, but the others too, Sirma, SGS, etc., are rebounding quite smartly. But let's get to TVS Motors. Numbers came out yesterday. The street liked the margin expansion, but post-market hours, we had the conference call. So Sudarshan is now joining in to give us details of that. Sudarshan.
So TVS Motor had reported earnings that were better than estimates. Company had reported margin of 11.9%. That was at an all-time high in a quarter. Now in the con call, company has mentioned certain details which are looking very positive. First, on the margin front, company is saying it's looking to improve the margin even from the current level of 11.9%. And how will it come? Company will focus on premiumization and product mix. Another important point that company has mentioned that any investment that if company plans to make in EV, it will be based on the customer feedback and if there is any opportunity. So it's very important point regarding the electric vehicle business. Even brokerages are positive on TVS Motor. UBS has a buy call with a target of rupees 3,100 per share. It says company has posted robust quarter with margin expansion despite seasonal weakness. Even outlook is robust with companies looking to gain market share in India and even in the export segment. JP Morgan has an overweight call, target is 31.30 per share. It has raised margin expectations for FY25, saying that now PLI benefits will be factored in the Q4 of FY25, and that's the reason it's raising the expectation of FY25. So earnings beat, commentary positive, brokerages are even positive on TVS Motor. That's the reason you are seeing a move of more than 7%.
Thank you so much, Sudarshan, for joining us and giving us a sense of what exactly is driving TVS Motors. Well, as we move on, we count down to Budget 2025. What are the key expectations from the jewelry space? Manisha joins in with more details.
Well, absolutely. All roads lead to budget right now. And as we've been discussing various sectors, so is the gold and jewelry sector as well that have put their ask or expectations in sense of budget 2025. Well, last year, the budget was a surprise and a cheer for the industry as we saw the import duty cut from 15% to 6%. Now, in that pattern, the industry anticipates that you could be looking at further duty cuts as well. And this has been an ask and an expectation as well that the duty could see a decline from 6 to 3% also. Of course, the street is divided onto this one because we've seen very strong imports in case of gold, even as the prices have been at an all-time highs. So whether that happens or not, well, we'll know in next 2 to 3 days. But the other asks have been quite interesting. The second thing that the industry is asking for is special benefit of 0.5% duty for importing through IIBX, that is the India International Bullion Exchange. This is in Gift City in Gandhinagar. The third thing is about establishing GST bonded warehouses. Fourth ask that we have seen the sector come out with is allowing of imports of gold only through IIBX. The reason that it was established, and if more and more could come through that, it has been 2 years for IIBX. Now, the first year did not see great volumes, but the second year has seen the quantum increase. And to increase that, there are some incentives that the industry is seeking for. The other thing also is about setting up of a jewelry export center at the Gift City itself, and this could be for domestic traders. The street is also looking for, or the sector is asking for, mandatory hallmarking when it comes to bullion. As of now, it is mandatory hallmarking for gold jewelry, but bullion and silver could be included is an expectation. The other thing also is about stopping import duty benefits, from least developed countries and the kind of FTAs that we have, where you have duty very less. And in garb of platinum and various other gold alloys, we do see gold coming in. So if this can be stopped, we could be looking at all gold then shifting in with whatever the import duty that the government fixes there. And the other one is even more interesting. Well, you have EMIs for various white goods, luxury goods and expensive goods there. But when it comes to jewelry, EMIs are not permitted. So this is an ask that the industry has from the finance minister of permitting EMI on jewelry purchase as well. Another thing is about capital gain tax, which the industry asks that should be removed on investment when it comes to gold. And finally, when it comes to gems and jewelry and gold, there are various regulators, right from RBI to Finance Ministry to Commerce Ministry. So this is an ask that the industry has had for the longest time, that there should be a single regulator regulating gems and jewelry as a sector overall.
Thank you very much for that, for explaining it so well. We need to get into a short break. On the other side, a corporate conversation. The management of JSW Energy will join in to talk about their Q3 numbers and more.
Welcome back to Trading Hour. Well, if we could put the spotlight for just a minute on AGI Greenpack, in the last 10-15 minutes of trade, that stock, which was trading well in the green, is now down almost 15%. So more than an 18% drop. We understand that there was a court case schedule of the company today, and it requires to be seen what exactly is the verdict out of that particular court case. We'll get you more details on that, but for this, at this point of time, the stock is down well over 15%. Well, we'll now shift our focus to the earnings season. JSW Energy reported a muted Q3 set of numbers. Revenues declined 5.5%, while EBITDA declined over 17% sequentially. The company also saw its margins come under pressure. Earlier today, we spoke to Sharad Mahindra, who's the joint MD and CEO at JSW Energy, on his outlook on merchant power volumes and spreads going into Q4. Let's listen in.
See, merchant tariffs, which we have definitely seen in Q3, have remained lower when we compare with last year. In Q3, when the merchant tariffs were about 5 rupees 1 paisa, against that it is about 3 rupees 70 paisa. That is the difference. The tariff remains compressed. But yes, this has been, but we have to understand that the demand growth in the quarter was comparatively lower. We have witnessed Q3 consumption growth of only 2.7%, but this is at a very higher base. If we recall, in Q3 of last fiscal, the demand growth was 9.9%. On a higher base, 2.7% in absolute terms is a reasonable growth, I will say, though it has slowed. Last quarter, we have witnessed extended monsoons, and then the extreme weather conditions. All those things made the demand growth comparatively lower. But the peak demand, the decline is not there. Against last year during Q3, when the peak demand witnessed was 222 gigawatt, this year it has been 224 gigawatt. So it is more or less same. So demand growth continues to be healthy, and going forward, the outlook is that with more of the indicators which are coming in terms of government spend and also the private investment taking pace, and the manufacturing growth and the PMI continues to be healthy, we are absolutely confident that the power demand growth will be significantly better going forward from Q4 onwards. And the indications, both in terms of demand and in terms of the merchant tariffs in first 25, 26 days of January, have seen a significant upside as compared to what we have seen in quarter three.
Last quarter when we spoke, you mentioned about how you were ahead of schedule in terms of capacity addition. So at the end of Q3, where does the current capacity stand? FY25, where will your capacity stand? And in the next couple of years, what kind of capacity addition can we see from JSW Energy?
Yes, as we have informed that by March 25, we'll be reaching a capacity of 10 gigawatt. So I'm happy to tell that end of quarter three, we are at 8.12 gigawatt operational capacity. And as we are talking in January, on January 28th, 29th till yesterday, the capacity, commissioned capacity is almost 8.8 gigawatt. So in January month only, we have been able to add close to about 0.7 gigawatt of capacity, which includes the synchronization of the second unit of Ind-Bharat, which will give us a significant advantage going forward when the demand season is now picking up. And it is a very low cost, fuel cost plant, which is close to the mines with domestic coal. So that will give us an advantage. And also the wind capacity addition, which has happened in the month of January. Along with that, a small acquisition of Hetero, 125 megawatt wind capacity. So all these put together, we have already reached at 8.8 gigawatt, and we are absolutely certain of reaching 10 gigawatt by March 25. And now going forward, maybe next few years, as we said, that now once we reach 10 gigawatt, including this 10 gigawatt, the total portfolio order pipeline which we have is 28.2 gigawatt, which includes the acquisition process which we are expecting in next few months to be consumed, which is O2 Power, which is a large platform now of 4.9 gigawatt, out of which operational capacity by June 25 will be 2.3 gigawatt. So that will get added into this 10 gigawatt number of March. Apart from that, the KSK Power, which is a 3.6 gigawatt plant, 1.8 gigawatt fully operational. That process also we are expecting to be completed maybe in next few months. So that will also add to 1.8 gigawatt.
We want to talk to you about the BESS project. CERC rejected the tariff. We understood you've appealed to the APTEL tribunal. We understand that the next hearing is on Feb 6. So what is the case that you have made, and what is the positive outcome or the negative outcome? How do you assess that particular situation?
See, we don't see any negative outcome. Let's see, the process is sub judice. The order clearly says that SECI has delayed the signing of the BASPA, the purchase agreement, power purchase agreement. And SECI, in fact, has asked 3 times to us to give the extension, which we accepted also. So it is not that there is any kind of delay or any such thing from our side. And if we see the old precedences, there are many. Today, when we are talking, we all know that solar tariffs in the competitive bidding today being discovered are in the range of 2 rupees 50 paisa, 2 rupees 60 paisa. But maybe 8-year, 10-year, 12-year-old PPAs of solar tariffs of 10 rupees, 12 rupees, 15 rupees are still being honored. So it is a technology which is evolving, and this is always witnessed in a new technology. And that was the need of the country that time. There was a huge focus on energy storage to ensure that with the increasing capacities of renewable energy, the grid stability is going to be a key, and battery storage is going to play a very key role. So we have the tariff adoption. The reason which has been given is the delay by SECI. Sufferer are we. So we have appealed in the APTEL, and we are, let's see that, but we are confident that APTEL will see it realistically and will come out with their own decision.
Thermal, battery, pump storage, you are aggressive in adding capacity in all 3. Now, battery prices are much cheaper. The way forward is a hybrid. So going forward, where will JSW Energy's focus lie as far as adding capacity is concerned?
Of course, hybrid is the key, and not only the hybrid, but the FDRE, which very rightly said that battery prices have moderated significantly, had come to a reasonable levels. So I think FDRE solution of giving maybe 70 to 80% RTC green solution along with a hybrid of wind solar is the key. And that is where we are seeing the bidding happening in this space.
Well, that was the management of JSW Energy. The stock now down over 7%. Let's now slip into a short break. When we return, we will discuss market technicals with Mitesh Chakkar and also discuss their top trading bets.
Welcome back. Let's address the markets for now because we are seeing a pretty good recovery, though in the last few minutes we've come off. There has been a bit of a tapering off from 11 o'clock. We were above 23,100, so from that level about 30-40 points gone, but still holding up pretty okay. Steady day. Mitesh is now back with us for a technical check on the markets. Mitesh?
I think the markets, I've been maintaining this that there's early signs of a reversal or a bottom formation in place. We need some more confirmation as the price continues to rise, and I think that process is still playing out. The Nifty, I would look at levels of around 23,150 to begin with, and then maybe look at 23,350. Beyond that, I think a bigger trend reversal could happen. Similarly, on the Bank Nifty, 49,350 is the first level, then 49,700, and then 50,000. But I think there are signs that the indicators on the daily charts are bottoming out. So with some choppiness, I think we'll maintain a long bias and look at, buying on every decline as well as looking at stocks where we can see some reversal.
Understood, Mitesh. Mitesh, any individual stock calls?
JK7 is something which I recommended in the morning pre-market trade as well. But if somebody missed that, even now, since the stock is breaking to all-time highs, JK7 is a buy with a stop at about 48.60 and a target of 5100 can be looked at. The early target was 4950, which is met. Now I think we'll revise it to about 5100. And some bullish traction is happening on the charts of Tata Steel, which I would wait for a mild confirmation to buy. So buy above 131.5, look for a target of around 134.5 and keep the stop below 130. 134.5, once that's cleared, we'll look at higher levels.
Understood that. Thank you so much, Mitesh, for joining us and giving us both your view on the index as well as your individual stock calls. Let's take a quick break. Management of Dr. Agarwal's Healthcare joins us next to discuss their latest plans as they eye a D-Street debut. Welcome back to Trading Hour. Well, let's now shift our focus to the primary markets. Dr. Agarwal's Healthcare is eyeing its D-Street debut with a 3,000 crore IPO, of which 300 crore is a fresh issue. The issue opens today and ends on January 31st. The company aims to repay their borrowings and for general corporate purposes. To discuss this and more on Dr. Agarwal, we have Dr. Amar Agarwal, Chairperson and Non-Executive Director, along with Adil Agarwal, Whole-Time Director and Chief Executive Officer at Dr. Agarwal Healthcare. Join us now. Thank you so much, both of you gentlemen, for joining us. Dr. Amar, first up, give us a sense of what exactly are you raising the funds for? What is the current debt on books? What is the finance cost at which this particular debt has been taken? What will be the debt post-IPO and what will be the reduction in the annual finance cost?
So basically, if you see, we are going in for this 3,000 crore IPO. And yesterday, we had the anchor list done up in which we had collected 875 crores. These were from the top marquee anchor investors like the GIC, Government of Singapore Sovereign Fund, Tata Mutual Fund, and White Oak, and all the top players have invested in this. And so we have got an 875 crore book closed yesterday. Now, coming to the money which is coming in from here, basically we are there to reduce our debt. So out of the 300 crores, we are using 195 crores to clear our debt because our eventual aim is to become like a debt-free company. At present, we have got about 209 hospitals and we are opening approximately one hospital every week. So if you see, last year we opened 45 hospitals and this year in the first 6 months, we have opened 30. In our growth, since you asked us the question, the growth also, we are growing for the past 3 years. Our CAGR is at about 38% and our EBITDA growth is at about 42% CAGR. That is the way which we are growing. Another thing is these countries which we are in are 10 countries. So we are in India and in Africa. Approximately, we see population of India is about 150 crore, population of Africa 150 crore. Between these two areas, we are covering half the world. Our advantage is we are asset light. In other words, I don't need to build a hospital of 400 beds, inpatient beds, because we don't have inpatient facilities at all. So we are able to grow more horizontally as much as we want. In Chennai, as an example, we have about 21 hospitals already existing. In Mumbai, Maharashtra, we have about 26 centers. In Mumbai alone, about 15. So the idea here is for expansion. Look carefully, we are not in Delhi, Uttarakhand, Chhattisgarh, UP, we have one center in Varanasi. That is where I'm saying we can expand so much more. And that is why the business opportunity is huge.
Congratulations, Dr. Agarwal and Adil. Thank you for joining in. This is Rima here. Just a quick question. One hospital per week. What's the eventual aim? When does this expansion stop? Do you have a number in mind, Dr. Agarwal?
Hi, Rima. Thank you for having us firstly on the show. We have gone through a significant phase of expansion over the last 3.5 years. And this is something which we've been doing for the last 5-6 years or so, where you see our footprint has been expanding significantly. We will continue to explore a lot more opportunities across the market. As you can understand, the TAM in our current industry is around 37,800 crores. And one of the reasons why this industry has such a large TAM is India has 275 million people who are affected by some form of visual impairment. And the second requirement also is to serve this kind of a population. India has only 1.8 to 1.9 ophthalmologists for every 100,000 people, whereas the requirement is 8 to 9 eye doctors for every 100,000 people. The third data point I would give you is India, on an average, is only doing about 400 to 500 surgeries for every 100,000 people, whereas many of the developed nations are doing 3 times that amount. Given the increased incidence in cataracts in our country because of a few demographical reasons, the requirement for us to serve this particular market is significant. Although we don't have a particular number in mind, but as we continue to expand our footprint, we will keep looking at more opportunities to meet that requirement and serve more people.
Dr. Amar, we understand that you intend to open one hospital every week or one center every week. Give us a sense of the kind of capex that you have envisaged maybe over the next year or so. We also understand that you intend to reduce debt, but given the fact that the majority of the IPO is via OFS, how exactly will you fund this acquisition? Will you need to take on more debt or will it be via internal accruals?
A lot of money on internal system, and I'll ask Adil to tell you the numbers in detail of the primary centers, secondary centers, and the tertiary centers, and our capex for that.
We have 3 different formats of our hospitals. Our largest formats are what we call the tertiary hospitals. These average anywhere between 10,000 to 12,000 square feet, although you have some larger facilities which are north of 40 to 50,000 square feet. On an average, capex for a typical tertiary hospital is about 8 to 12 crores. Then you have a smaller format, which we call as the secondary hospitals, and these average anywhere between 4,000 to 8,000 square feet. Typical capex in these facilities is about 4 to 7 crores. And then you have the smallest formats, which are called the primary centers. Now, we call these the eye clinics, and we use these to cater to smaller micro markets, tier 3 towns, tier 4 towns, different villages. These average between 750 to 1,000 square feet, and total capex requirement for those is about 30 lakhs. Now, given our financial performance, if you see, we have a EBITDA to cash flow ratio conversion of about 85%. So we believe, based on the current situation, we don't require much external capital based on what our current plans are. Our internal accruals and whatever cash and investments we have on our books will suffice to meet our biomedical requirements and our capex requirements over the next 2 to 3 years.
Adil, as you keep expanding, is there a risk to your margins, or do you think you can maintain or expand margins from here on?
So that's a valid question, Rima. If you see, in the last 3 years, in October 2021, we had launched our 100th hospital. In 3.5 years now, we have expanded that footprint to 209 hospitals. Given the fact you have gone through such rampant expansion, we have still managed to maintain our margins at about 29.5%. This data which shows H125 is about 27.3%, but if you average it out extrapolated for the rest of the year, these will be close to 29 to 30%. We believe that we will be able to maintain these margins given our performance over the last few years. What we will not commit on is any improvement in margins, but we are fairly confident about maintaining the EBITDA margins at such a level despite our expansion plans. And the reason for that,
Yeah.
just one. The reason for that is if you see 70 to 75% of our centers we open in our core clusters. Now, core clusters are what we define as where we are present in predominantly the southern states of India, and Maharashtra also we would consider core cluster. The break-even time it takes to the amount of time it takes to break even in some of these regions is a lot faster. As we take on a few more risky bets and we start going to markets where the brand equity is not strong, the break-even period increases. So on an average, our break-even period is around 15 months, so which is why we believe we should be able to maintain these EBITDA margins which we have delivered.
So, Adil, or Dr. Amar, if you would like to answer this, it took you all 2 years to double your revenues and even double the number of hospitals. Do you think in the next 2 years, if we talk same time, your hospital count and your revenues would have doubled compared to these levels?
We are looking at that as a target. But let's look at those numbers. If you see, you were showing in the screen just now, you showed a turnover of 1,300 something last year. And if you see the turnover of this first 6 months, it's showing 820 crores. You can see the growth. And remember one more thing. Our growth is always in the H2 mode because there's a seasonal variation where patients come for cataract surgery more during winter. So you can extrapolate and you'll see the growth. Perhaps Adil will add more on it.
Adil?
Yes.
Do you think we can double in 2 years?
I would not like to make any commitments on doubling of revenue or doubling the number of centers because this is, there are certain risk factors in our business. For example, our business is built around getting the right set of doctors and providing the right kind of clinical services. Post-COVID, also, we have seen, a healthy kind of growth. And that is a phenomenon which is not just unique to us. Most of the other healthcare players also have seen this kind of growth, predominantly because the Indian population has started to take their health a lot more seriously. But given our expansion plans and given our track record, at least in H1 FY25, we are fairly confident that we should be able to at least keep up with this current growth which we are showing.
Thank you so much, gentlemen, for joining us and giving us a sense of how exactly business is expected to pan out post-listing. Well, ITC Hotels listed today. Mangalam joins in with key details about this particular demerged entity of ITC.
Well, if you look at the discovered price of the ITC Hotels business, it's close to around 178 odd rupees per share, and which is pretty much in line with what the analysts had expected. Optically, the stock looks a lot lower than the implied value of 260 rupees per share. But remember, the implied value was basically implied by the difference between the stock price opening on the day it went ex-hotel business versus the previous close itself. The underlying assumption was the entire difference was the value of the hotels business, which is not always the case. If you look at, close to around 170 to 180 odd rupees, the stock trades at anywhere between 26 to 28 times FY26 EV to EBITDA, which is fairly in line with what the street was ascribing in terms of a multiple to that business as well. ITC Hotels, for instance, should be positioned as per analysts somewhere between Indian Hotels and Chalet Hotels as well. Chalet Hotels close to around 25 times, Indian Hotels trading at 37 times at a premium to all the other players in the industry because of its leadership position. Put ITC somewhere in the middle, 26 to 28 times, and that gives you the value of close to 170 to 190 rupees, this range in which the stock has been trading, and the price which was discovered in today's trading session itself. The question now, fundamentally, we'll keep an eye out on the hospitality sector, how this business performs. Remember, it's a debt-free company with 1,500 crores of cash. But technically, we'll keep an eye out on the flows around the stock as well, because as per Nuvama Quant, the stock is expected to meet criteria for inclusion in MSCI Global Small Cap Indices. So if and when that notification comes in, there would be some inflows of passive funds. But at the same time, over the next 3 days, we may see outflows from passive funds as well, because remember, because of this technical adjustment of the demerger, the stock is still a part of the Nifty. So it's the 51st Nifty stock. It will be excluded from the Nifty 3 days from now itself. And once that happens for both Nifty and Sensex, there could be potential outflows of $100 million for the Nifty and $65 million for the Sensex as well. So we'll keep an eye out on those parameters here.
Thank you so much, Mangalam, for joining us and giving us a sense of how exactly to value and look at this particular business. Time now for a short break. JSW Infrastructure's Lalit Singhvi joins us next to discuss their Q3 numbers and more.
Welcome back. Let's welcome another management on the show. JSW Infra reported a stable Q3, revenues up 25% year-on-year. Margins, though, contracted to 36%. Lalit Singhvi, whole-time director, CFO of the company, is now with us on the show. Thank you very much, Mr. Singhvi, for joining in. This is Rima here. The first question is, are you on track to achieve your FY25 volume guidance of a 10% growth? Because the ask rate in Q4 is a bit steep.
Good morning, Rima. Thank you for having me here on your show. So, yeah, we are very much on the guidance. So, we don't see that there will be any deviation. And fourth quarter is typically better for us all the time because minimum guarantee tonnages gets built in the fourth quarter. So, that is, every year it's like this.
Understood that, sir. Sir, we want to understand that overall port volumes, especially H1 and even part of Q3 was slightly sluggish. So has that trend reversed in Q4? We understand that you have some built-in volumes for Q4, but overall, how's the environment? And also, could you give us an update on the commissioning of the various brownfield projects that you had announced earlier in terms of Jaigarh, Dharamtar, as well as Goa? Even Greenfield Jatadhar port, what exactly is the status on those ports?
Yeah, so Greenfield ports are all on track. So there are new ports like Kenny, Murbe and Jatadhar. They will take some time. It will be, from 2 to 3 years time frame it will take. And we have some brownfield things coming up at Jaigarh Port and Dharamtar that we are expecting 1.5 years time frame. They will start. At our Goa terminal, our covered shed is almost through. By March end, it will be through. And next financial year, we are having, we'll have that additional cargo coming in. Secondly, our Tuticorin terminal and JNPT terminal, which we have won last year in a PPP model, there we have got interim permissions to start the operations. So that will further add cargo in our 25-26. Both at JNPT and Tuticorin will be having additional cargo coming in.
Understood that, sir. So, what we also want to understand from you is significant brownfield, greenfield capex. Even in your presentation and in the conference call yesterday, you've given detailed explanations as to how exactly you're going to turn around the Navkar Corp acquired assets. All of that will require significant capex. You also have the promoter shareholding in excess of 75%. So the QIP on the horizon. That is the first question. Second question: could you give us a year-wise breakup of the capex spends envisaged?
So QIP, we still have a time, that as a regulator's requirement, we can, come with the QIP by October 26. So we still have time to go. So we don't need money. Right now, we are sitting on a cash of 4,500 crores. So, but as and when the need comes, we will certainly go for QIP because we are, we have to go by regulator's requirement. And next 3 years, as we look at it, we will be spending on the port side around 15,000 crores. And on the logistics side, we have just given a guidance that over a 5 years time frame, we will be spending 9,000 crores. And out of that, 1,000 crores is already spent on acquisition of Navkar.
Okay. So your share of third-party cargo has increased to 48%, and that number was literally 5% in FY19. So in a span of about 4 or 5 years, what's the mix going to be going forward, and how is the JSW Group cargo volume shaping up?
So in the last 5-6 years, that our focus was broadly on, on third-party cargo. So all the investments which we have done in the last 5-6 years has gone into increasing capacity for third-party cargo. So that is a result that, from 5% we have reached to now 49%. And JSW Group, if you see, for the steel or cement or energy for that matter, they will have a lumpy growth. Whenever there is a capacity additions, they will have a huge, jump in that their cargo. So right now, say there is no capacity additions for JSW infra purposes at Dolvi plant, so cargo is flat. So all our growth is coming from third-party cargo. After 2 years, once the Dolvi plant takes from 10 to 15 million tons, we'll have a 30 million tons cargo coming up at Jaigarh Port and Dharamtar put together.
Understood that, Mr. Singhvi. Mr. Singhvi, you also understand in the call yesterday, you've actually given a clear timeline in terms of going ahead and increasing your capacity by 2.3 times to to 400 million tons by 2030. Could you give us the year-wise breakup and also the capex, if you could break it up for us?
Yeah, so by 28, we will take it to 292 million tons. Currently is a 174 million tons. We were 170, but then we have added some capacity at PNP port and our Mangalore coal terminal. So now it's 174. And in 3 years time frame, we are taking it to 292 million tons. So there would be additions of brownfield expansions at Dharamtar, Jaigarh, Goa, Mangalore container. So these and LPG terminal at Jaigarh port. And our Jatadhar port and a slurry pipeline will also start, operations by that time. So this would, you can take 4,000 crores or every year investment taking place, 4 to 5,000 crores. So we hope to invest around 15,000 crores in next 3 years time frame.
So 15,000 crore capex that you have envisaged over the next 3 years and looking to reach the 300 million ton per mark by 2030. Give us a sense. We understand that you're looking to go ahead and become an end-to-end logistics player. You've given a significant presentation in terms of how exactly you're going to go ahead and turn around the Navkar Corp asset. Could you give us a sense of when you acquired, what is the capacity there, how was the operational efficiencies over there, what's been done so far, and at the end of FY26, how will Navkar contribute to your financials?
So we acquired Navkar on 11th of October. So it's few months operations only, but we see a lot of potentials in the Navkar. And as we said, this is the first steps towards our larger foray into the logistics sector. So whatever Navkar can take in their books, we will be investing to that extent in Navkar, but we will be going beyond Navkar. We have set up a structure in which JSW Infra holds JSW Port Logistic Company, and under that Navkar comes. So we will have many more things coming up in the logistics sector, and that's why we have kept 9,000 crores of investment into logistics sector. And we are looking at various things like GCT under the government's Gati Shakti programs. So there we'll have a low-cost, additions of various ICDs and CFSs within that. So we look forward to have around 15 to 20 such centers across India. So these investments, will take place in next few years' time. We look at 5 years' time frame in which we will be able to have this. And our model would be like, the same as of a port, where we get a group support. So base cargo comes from the group, and then we add it up with the third-party cargo. So here again, this logistics sector also, it will work very well because group needs the logistic support, and they have a very good spend on the logistic, and part of that comes to JSW Infra's logistics sector. It will have enough for us, and then we can top it up with the third-party cargo.
Mr. Singhvi, one last question, request to keep it brief. Any acquisition targets on the horizon? Who are the targets that you've identified? We understand there will be significant inorganic growth required to meet your 2030 target.
Yeah, we are looking at certain opportunities. So since we are, in the middle of that, we will not be able to name that. But we have, some amount left for this acquisition proceedings. So let's see, in next few months, we should be able to, we'll come out with those things.
Thank you very much for joining in. Interesting conversation there with JSW Infra. Get into a break. But on the other side, we go full tilt on the upcoming budget. We'll get you what the street expects from the budget, and we'll focus on the individual sectors.
Welcome back to Trading Hour. Well, moving on to what exactly does industry want from the budget, Winnie joins us now and tells us what the realty players are expecting from Budget 2025.
Hi, good morning. So in terms of obviously the boost that we're expecting, especially on priorities from the government side, we're expecting is going to be from infra as well as the real estate side. Now, in terms of the real estate side, affordable segment, talk about that. An affordable boost is what we're expecting. Affordable housing may witness a boost this time. Relaunch may come in terms of certain subsidies or schemes is what one is expecting. CLSS under the PMAY scheme, that will be something that is important to watch out for, especially in terms of improving affordability. Upward revision is something that we could watch out for the carpet area, as well as monetary limits for the affordable housing segment, and allocation to additional funds to the SWA MIH fund is something that could support the completion of the stalled projects that are there. So these are the key expectations that the industry has coming in from the affordable side of the business, and affordable boost that one is expecting. Stocks that one could keep an eye out on obviously will be the affordable housing side segment stocks that one should watch out for. Now obviously raising of debt deduction limit for home loan interest and principal is a key boost, as well as reduction in the GST rates for construction material, particularly cement, will enhance the overall affordability. So mainly the boost that we are expecting this time from the real estate side is going to be for the affordable housing segment. So let's watch out for what actually comes in from Budget 2025 this time.
Thank you so much, Winnie, for joining us and telling us about what exactly is the industry expecting as far as the realty space is concerned. Well, I've been tracking the power space and what exactly is the entire energy sector looking forward to from Budget 2025. Well, Morgan Stanley says that the government should go ahead and reiterate its thrust as far as clean energy is concerned, with a likely emphasis on the renewable space. Along with that, they are anticipating equity allocation to financial institutions, battery storage adoption, small reactors when it comes to nuclear energy, pump storage projects, as well as going ahead and working on a roadmap to ensure that the smaller industries don't really fizzle out when it comes to a requirement for power. Along with that, there is an expectation that there will be a step up when, as far as capex is concerned, as far as more details are concerned, when it compared to the interim budget. What is it that Jeffrey is saying? Jeffrey says that they are expecting continued government push as far as renewable energy is concerned. This includes high allocation for schemes in the solar energy as well as the hydrogen mission. They're expecting more details coming in and more thrust towards the PM rooftop solar as well as the Kusum scheme, and also enhancement of PLI incentives in this particular space. They want incentives as far as battery energy storage is concerned, and also they're expecting the government to announce renewable energy zones with RE projects, that is solar, wind, as well as green hydrogen, coming under this particular renewable energy zone. Lastly, they will also be looking out for any change in import duty structure and modules as well as cells, especially in the solar space, and any change in the duty structure there is something that will be very important to watch out for. But that's from the power space. Finally, on to the key expectations from the auto sector. Sudarshan joins in with what exactly the auto experts are waiting for.
So for the auto sector, it's expected to be all about electric vehicle space. So industry bodies expect direct incentives or schemes for building an EV supply chain, mainly for batteries. And industry say this will aim to increase the domestic value addition in battery manufacturing to 50 to 60% and reduce the reliance on imports. And this will be positive for battery makers like Exide, Amara Raja. These two stocks will be in the focus. Second is charging infrastructure and energy storage system. Basically, industries expect government to enhance charging infrastructure, energy storage system, and increase the support by government in R&D for clean energy, green mobility, and semiconductor. And this will be positive for stocks like Bajaj Auto, TVS Motor, Ola, Tata Motors, M&M, and JBM Auto. Last, if there is announcement of increase in rural development schemes, and this would be positive for entry vehicle makers, like in two-wheeler space, it would be positive for Hero Moto. In four-wheeler space, it would be for Maruti, and in tractor segment, it would be positive for Scott's Kubota and M&M as well. So these are the three key focus areas that auto sector is looking for in upcoming budget.
Thank you so much, Sudarshan, for joining us and giving us a sense as far as the auto sector is concerned for Budget 2025. Well, with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.